I'm Steve Afra, managing partner at Nvestor Funding and a real estate investor with over 35 years experience. For this topic in this video, we're going to be talking about how data really helps real estate investors, not be able to make mistakes and help them really become profitable in any sort of real estate venture or project that they get into. I know that it's something that I use. I don't, the data that I use usually when I'm doing anything, I think the biggest pitfall is that a lot of real estate investors, especially the new ones, are just relying on algorithms that pop out from, let's say, Zillow or Realtor.com or Redfin or things like that, right? None of them are really going out there and doing their own research on the comparables, right? And what is a comparable? A comparable is a property that's sold maximum, I guess it depends on where it is. If it's rural, it's going to be tougher. But if it's not rural, if it's in the city, maximum half a mile away from the house that you're buying, right, or trying to invest in, and with the same specs, meaning same square footage, same bathroom count, right? Getting those comparables yourself, analyzing them, and making sure that you're taking the lowest comparable. Right, you never want to go to the highest because you're not leaving yourself with any room for a correction or a mistake, right? So if you have one that sold for $300,000, another one sold for $285, and one sold for $250, compare it to the $250. Don't compare it to the $300,000 one. And that's very important.
Will that be considered underwriting a deal, like?
That's part of the underwriting, yeah. So analyzing, underwriting the deal. The other part of underwriting would be looking at the project. If it's a fix and flip, making sure that the material costs, that you're doing those costs yourself. Going to Home Depot, understanding how much sheetrock is going to cost, understanding how much paint is going to cost you, this and that. Understanding those numbers and not really relying. What a lot of people do is they'll bring in a contractor. And what's a contractor's business? The contractor's business is to make money, right? So, in a job that could potentially cost $15,000, if you don't know, a contractor could come in and say, oh, it's a $65,000 job with them earning $50,000 in the middle, right? And I've seen that happen time and time again. So, but if you understand what the actual costs are, you're not going to fall into that trap. Right. Once you go out there and you get that, and there is data out there to know, hey, in this particular market, how much should sheetrock cost me? So that you didn't have to go to Home Depot, right? In this area, how much should flooring cost me? And then the data will tell you, and then underwrite it in that way and make sure that you have that down packed. The other thing is underwrite for your exit, so you understand. Well, I'm planning to go out at the lowest comp, right? At that 250.
250.
How much am I going to make? Is it still worth my while? Okay, yes it is. Now, God forbid something happens, I can't sell at 250. Market really softens up. Well, what's my plan B, right? Because a lot of people don't have plan B, and then they're sitting there like a deer in headlights saying, "Oh, what am I going to do? I don't have plan B." So have multiple plans. Plan B should be, if this doesn't sell, well, can I rent it? And what can I rent it for? And if it's not debt servicing, then you're in trouble. Then you have to figure out, well, how am I going to make this property debt service? What should I do? Or, you know what? In a market like this, maybe if it's not going to debt service, I'm going to walk away. I'm not going to do the deal.
I love that. So all of that is part of underwriting.
All of that is part of underwriting.
Including exits.
Yes.
So what about spotting trends? Most of the people that have accumulated huge wealth is because they spot a trend early. The internet bubble, this, that, So how can you in real estate spot a trend before the market reacts to it?
So this is the thing. I like to tell people, if it hits Instagram and it blows up on Instagram, it's too fucking late. It's too late. You've missed it already. If these schmucks on Instagram are talking about it, guess what? It's just, you're done. It's over. That trend is finished. You're on the tail end of the trend because all the ones that were doing it, I'll give you a perfect example. The guys, Airbnb, now everyone's an Airbnb, specialist, right? Everyone, how long do you do short-term rentals? Short-term rentals is the thing of the past, right? How you could spot the the trends is sometimes you're going to have to make the trends too to know, well, do my research. What are the emerging markets, right? If you hear about Nashville being hot, by the time you heard that this Nashville is hot, guess what? You missed a boat. But, well, what are the surrounding markets of Nashville?
They haven't caught on fire yet.
Where are people? Because people, once Nashville becomes Nashville, guess what happens? Things become unaffordable, right? So people have to, there's an overflow into another market. Where is that overflow? Where are these people moving to if it's not Nashville? And then you start, checking out the markets, the surrounding markets of, let's say, Nashville, or let's say, any other hot market that you could think about. And that's finding a trend. That's finding, what's right and what's working. That's how you're going to hit it.
They say that the owner of the chicken that puts golden eggs only sells the chicken once she stops putting golden eggs.
That's right. And that's the truth.
You'll never sell it before.
Nope.
So it's the same with trends. So something that I picked up from what you were saying is, number one, forget about what the trend is and focus more on the numbers.
Yeah.
Forget about any type of narratives and dreams and focus on the numbers.
Yeah.
So basically it's all look at the numbers.
It's all numbers.
It's all math.
It's forget about the hype, right? It's all, what does 2 + 2 equal? It equals 4. Now, what ends up happening is with people put emotion behind it, right? Oh, did you see the trees over there? I really like the trees. And then they try to make 2 + 2 = 5, right? And not understanding that, you know what? It's not your personal residence. This is a house that you're looking to make money off of. And you have to stick to the principles. You have to stick to the numbers, because the numbers are what's going to equal whether you're going to make money or you're going to lose money. And once you put that emotion in,
it's gone.
Then you're screwed.
Yeah. They say that pros are pros because they focus on the basics more than the amateurs.
Correct.
So amateurs are just looking to shiny stuff,
right,
pretty stuff.
And guess what? Some amateurs win. And when there's amateurs winning, amateurs win when, let's say, in an upswing market, they got lucky, right? They're not doing their numbers, but prices are upswinging. So no matter what, it's hard to miss. But guess what? I've seen people pay that back tenfold when the market starts dipping, because they think there was some sort of genius. Meanwhile, they weren't anything. They didn't know what the hell they were doing. They got lucky with the market. Correct. They tried doing the same thing on the downswing market and lost their shirt.
Yeah,
but I've seen that a million times over. A million times. The bottom line is, at the end of the day, numbers speak for themselves. Forget about what's trendy. Forget about what people are talking about on the internet. Forget about what's the new shiny, product, right? Look at the numbers. If the numbers pan out, it's a good deal. If they don't pan out, there's no surprise. You're going to end up losing money. Maybe you won't lose money in the beginning. Maybe you'll get lucky. Right. But if you keep to that formula, at some point you're going to lose. And unfortunately, you're going to lose big. We'll see you later in the next episode. Bye.